Welcome back to the Inorganic Podcast. My name's Christian Hassold. I'm your host. This is episode 27. This is part two of an episode of episode 26. This is part two. So part one, part two, or as the episode title says, 201A and 201B. This is like college courses. We're going through the 201s of agency valuations in the modern age. And back with me for this episode is my guest and friend, Ayelet Shipley. Ayelet, welcome back.
Thanks. Excited to be back.
So where we left off in the last episode is we had talked about the macro market conditions of all the agencies and sort of valuations and sponsors and kind of like the dynamics that lead into valuation and putting together, as you put it, like how do you get buyer and seller to come together in the right way on an agreement of what is going to work. And we went through one scenario where we had a $25 million revenue agency with a $5 million EBITDA profile priced at 8x. And we kind of walked through. You can watch that episode and walk through how we did it. So that was more of a standard kind of a deal that we walked through. In this episode, what we're going to do now is we're actually going to go through two more example deal structures and probably some bonus clips to come along the way because we both are working on live deals right now. And there's so much interesting stuff happening. Ayelet is going to share what we call Scenario D, which she's super excited about and which is a really interesting structure that we're all going to learn something from this because I've been completely misinformed about a particular term that has been used frequently in deal structuring. So with that set up, I'll turn it over to you, Ayelet, to kind of give a little background on Scenario D to the extent you can, and then kind of go into the structure itself.
Yeah, absolutely. So this scenario is one of my favorite because most people view higher EBITDA deals as more attractive, right? However, there is a lot of creativity that people don't think about when we're getting to deals that are below 2 million in EBITDA, which even if you're going a little bit beneath 2 million, there's still a lot of room there, even though it's very close to the 2.5. So for this deal specifically, the business is doing revenue-wise 3.4 million in revenue with about an EBITDA of, what did I say, 1.7?
Yeah.
Yes, 1.7 million in EBITDA.
3.4 and 1.7. It's an important point to state for the audience why under 2 million is hard. We should tell them why is under 2 million in EBITDA hard?
It's the EBITDA marker that becomes less attractive to buyers because the smaller the EBITDA, we view it as the more risky the business, unless you think of it otherwise.
And what happens is our lenders come in, our accountants come in, and they start saying, well, doesn't count, and that doesn't count, and that doesn't count. So you have all this sensitivity around a deal valuation. 300,000 falls out of the picture, and all of a sudden 300,000 goes away on a 10x deal, like you just lost $3 million, and that could be problematic. So that's why it tends to be, as a matter of practical history, that under $2 million businesses have very sensitive EBITDA margins. They're just very sensitive to a lot of exchanges because of accounting treatment.
Yeah, they do. And that becomes a challenge on its own, which we can discuss in another episode of how to bridge that gap.
Another episode about EBITDA margins. Let's do that.
We could discuss that one. But for this, that's the best, reason behind where then there's now creativity in the deal, because oftentimes the person or the group that's financing the deal, right, they don't want to take as big of a risk. So buyer needs protection in these deal sizes. So for this deal, that's 3.4 in revenue and 1.7 in EBITDA, which is a very healthy margin, which we can get to in a second. We landed at a $10.2 million EV, which is a 6x multiple, which I will say for a 1.7 million EBITDA is a very strong valuation.
Very fair. Fair deal.
I mean, generous. I would say a 6x multiple is very generous on this. But the buyer wanted to protect themselves here, and they were willing to write a $10 million check at close. So how is this structured? So we decided that what we call the cash consideration is $5.1 million. And then the rollover would also be $5.1 million. So they are getting a 50% cash consideration. Now, here's the caveat for that. How much are they getting at close? You would think cash on close, right? Cash consideration. No, it's actually
cash on close. Here's my wire.
No, we're doing quarterly payments of the cash consideration spread out over 3 years. But the cash consideration, those quarterly payments, are actually performance-based payments. But it's not really like we're setting, these goals and it's not an earnout. It is, here is what we agreed the business is doing right now in revenue. If the business drops below 50% of that value, the payments for the next quarter, for the next year, actually, sorry, can be halted completely. If it falls between 50 to 99%, the payments are reduced on a pro rata basis. So this wasn't an earnout. There was no upside kicker. This is just saying we're willing to pay top dollar for the business, but only if it's actually the business that you're handing it over to us. So after year one, we're going to do a reconciliation and we're going to look at what the revenue actually was. And then we'll decide.
Can I ask you a question about that deal?
Yeah.
Everyone has happy years sometimes when like the negotiation's going well and they feel like there's a real win-win, but then you kind of have to play through the plays and it's like, well, what if there are 2 or 3 quarters where the sellers don't get their payment? And what happens? Usually it's sort of like, wow, that sucks. Why am I doing this? So how does a buyer sort of get confidence that they're going to have the high engagement from the acquired in the potential scenarios where they don't meet their numbers?
So this is how this one worked. First of all, if you think about it this way, and I'll make it clear that Buyer has an agency that's been around for a very long time, has significant infrastructure, has healthy margins, good EBITDA. This person was buying EBITDA, right, for this. This seller has only been around for a few years and they're growing very rapidly. The seller has full confidence in this business. If a seller really is nervous about the business hitting 50% of that, that's really low. And so,
He had to hit 50% of his number in order to get paid, basically.
yeah, 50% was it.
That's crazy.
That's the threshold. But then the 50 to 99, that's where it would be reduced on a purchase, right? So there's a lot of protection there for the seller too, because you're right, there are quarters. But by the way, we're doing this on an annual basis. So this was part of the discussion that we said, how would we do quarterly payments? And we said, you know what? At the end of the day, if they're really beneath 50% of the business, then like they shouldn't get those quarterly payments. But here's the kicker for this. This is where it comes in because the seller, yes, they wanted that cash consideration, but they also wanted cash ongoing in the business because right now they're taking really high distributions out of the business. However, so what we said was, okay, let's do this. You're going to actually be able to take, we're calling it like cash bonuses at the end of the year based off of certain profit margins of the business, capped at $1.5 million total per year, right? So there's still, and like that was decided on advance what those profit margins had to be, but it's a you win, we win. We're looking at the total value of the entity, right? Because they are going to get actually, so what it was is they're going to end up having 10% equity in HoldCo, like true equity, same class of shares, so that they're really taking participation in the future upside. Because this is the other important part. Buyer wants to sell in 3 years. Everyone is incentivized here. Everyone is incentivized for growth. So even if, that business stops, right? We have to look at the profit margins. You have two potentials to get tons of cash right now off the table. Everyone's incentivized in that same way, but buyer has those protections.
Higher probability lottery ticket in your pocket. This is a really cool deal structure because I think what it solves is something that is a frequent occurrence, which is if you're a sponsor and you're kind of larger and you find something smaller that you're really excited about and you want to be super reasonable and fair with the acquired, but you also want to protect all these unknowns. Like it's founders, agency owners, of course, they're always bullish about their forecasts. They're always going to hit their numbers. They're always going to like overachieve until you buy them and then something goes sideways. Is sponsors are sort of wired to not to account for a lot of downside risk because they have to. Their LPs expect them to be conservative. And so you can find that in deals, these two things kind of like knock at one another, which is, I've got a big plan. I'm going to do all this growth. Yeah, but what if you don't hit that growth? Well, we're not going to do that. Well, yeah, but what? And so you have to construct a deal. This is really interesting how this is put together in a way where you really aligned interests. And at the end of the day, if they didn't get the 5.1 in cash for some reason, they still had 5.1 in stock. So the value that they did give to the agency, ultimately they'll be able to participate in a reasonable time frame in the upside of the agency itself.
And they're getting the first year the year payments anyways. Like that they're getting the first year regardless. So they're at least getting that too. But it's exactly it, right? It's the how can you mitigate the protection for whoever is financing this transaction, as well as being able to participate. And there's also a high level of trust here because they're already cross-selling services. And so everyone's aware of each other right now. This is like a high trust relationship. And then we just look at, okay, the financing, this is how we're going to protect that piece to it. And this is actually way more common than most people are aware about, especially in like the traditional financing world for deals above 2 million in EBITDA. This is actually common practice that we're seeing a lot with these types of protections.
Yeah, that makes a ton of sense. Wow, very interesting. Okay, that's a great scenario. That's a very creative situation. I can see why you like it a lot. That's great. Maybe what we should do now is pop over to scenario C. I think scenario C presents some different dynamics. And so maybe we take it back out to market, which is, typically what we observe a lot of the time is that agencies hit a particular scale in the 10 to 20 sort of million mark where just time catches up with the founder, like operating the business or managing the churn. They tend to get to a point where something breaks and they just can't get past it. But there are some exceptions. There are material exceptions of agencies that for various reasons, there's founders, there's a really great CFO, COO partner in there running the house for you while you're doing the selling. You hire really well. And these businesses get scaled into the $35, $40 million range. And those businesses also frequently are running at 22, 23, up to 25% EBITDA margins because the founders, the operators realize, like, if I just run this thing really well and I don't take a lot of salary, I can just take distributions and do quite well. And so they just start engineering a cash machine. However, at that size and scale, you make yourself a target of competition, and the customers that you start attracting get bigger and want more things from you that you may not have. And so what happens is you land large contracts, and those large contracts churn unpredictably. And so you get to a point where you say, maybe I'm not going to 50, maybe I'm not going to 70 like I thought. Maybe now is the right time to exit. So I thought it'd be good to example a scenario C where you're a $40 million agency with a $9 million EBITDA profile, which is a good EBITDA profile, and a scenario where, because of your size and your scale and where you've been, you're able to command a 10x multiple. But the challenge that you're trying to solve in this scenario is that if you're the buyer, you probably are buying some contracts that are pretty large that have a risk of churning. They might churn because contracts in agency are constantly written very client favorable. Two, there are clients who say, I like smaller agencies. I like boutique agencies. I want to work with them. If a platform buys them, I'm just not as excited. It doesn't really matter to me. It gets harder to know for sure you're going to retain those clients. So the underlying financial case you have to make has to protect the buyer. Again, you're aligning principles. It's like you need the buyer to be protected from potential downside, and you need the seller to be like, hey, I'm going to get paid for the value that I bring over if that value sticks. So how do you construct the deal? Ayelet, how do you construct this deal?
So you do it still in a more traditional way, similar to the one in the previous episode we discussed. You're typically going to see an 80% cash at close. We said that they're going to get, because they're at 40 million revenue, 9 million EBITDA, we're saying an EV of 90 million, they're getting a 10x multiple on their business. We're going to give them $72 million cash at close. And then we're going to have them roll 15%. We want them to participate in the upside of this and really have skin in the game and be able to participate up in this. What we want to do is we want to give them a really good earnout. Because if they're saying, well, what if I could just grow to 50 million? I'm already doing this. I already have, I'm taking large distributions out. We say, okay, you have this faith in the business. Let's give you an earnout up to an extra $9 million in your business, because that's bridging the gap. So we see the EV as this right now, right? The EV is going to be 90. That's what we believe it is. We believe it's going to be that. But let's give you an extra. Let's bridge the gap and help you to get closer. And it's still seen as an additional kicker that they could get into the full, like another full $9 million in the earnout.
Yeah. It's interesting, again, coming back to what we talked about in the last episode, that the earnout is not counted in the EV. This is a very inconsistent practice. And it's like there's no right or wrong. It's sort of the prerogative of the sponsor, the acquirer. Can you give me a sense of like what is the survey of the market? Like, is it 50% are putting the earnout outside of the EV and 50% are counting it in? Like, what does that look like?
Yeah, so this is what I was going back and forth with because this is actually a lot of the deals we've seen. So I would say 30%, 40% of these deals are having this right now. This is just what we're seeing. And you can say, here's the multiple you're getting for your business right now, but this could be the total realized multiple that you're going to end up seeing with the earnout. And you're just putting both in it. And so we're seeing it a lot. I put all of these deal talks into GPT fully redacted just to see the potential, like see what the percentage breakdown is of this happening. And it was significant in this. And I think it's because this market and the agency world is interesting. One, because these nuanced behaviors started to just become a norm because people were letting things happen. So it started with smaller deals and now the trend moved up to larger ones. And so that's, I think, where it's really coming in. And it's one of the only places that we're seeing creativity and, work with the law firm that I'm at right now. And we have a few different industries we specialize in. And we're actually starting to try to bring some of that behavior into other industries as well because we believe that the more you can incentivize someone, the more you can align with what they want, the more they're willing to go and do the work. The biggest issue that always happens, especially in the agency world, is we worry that the people are going to leave, right? The clients are going to churn, the people are going to leave. That's what you're buying at the end of the day. So, how can you incentivize them even more?
Now, let me remind myself, is scenario C a real world scenario, or is that something, is that a deal like that has actually been done, or did you and I just kind of bake it up? Because I have a theory.
No, I have it combined with two different types of deals that we've done.
I have a theory that the practical reality is that this deal on for most sponsors would probably be an 8x deal versus a 10. And the reason why I say that is going back to the first episode where we were talking about where sponsors are marking their assets is if you're marking yourself at 10 to 12, you're not going to do a 10x deal, especially with this kind of an earnout. Because at the end of the day, whether you count the earnout math in the EV, the earnout is still a part of the calculus on your own internal books. Because like if you pay for it, you pay for it. It's like whether it's in the headline or not, you're paying for it. So it's going to be in the model. So my guess is that practical reality is for the purposes of this episode, we kind of maintain a little anonymity to protect the innocent. But I think this is a more likely deal, in the 8x territory on a headline basis. And that earnout is used to kind of bridge the gap to 10. Is that a fair articulation in your mind?
Yeah, I would say that is. I also think that it also depends on who the sponsor is and what we are also willing to do depends on the time frame of everything as well. We've taught, I think in the first piece of this, we said, okay, well, here are the multiples in which the market is seeing, but here is what actual deals that have closed that have public knowledge of what they've traded at. And I know smaller deals that have traded at 12x multiple. Like it's crazy. But it's also because they needed that service capability and they needed that deal at the same time frame because they were about to go out for another round of financing and they were outgrowing their PE firm and that was just the case, right? And so they were like, we want this, we need it, we can get this deal done, and we believe that this is worth it right now. And so we're willing to pay that, right? That's not this scenario. It's important to note that timing is everything. And that goes back to the same thing that we said earlier is like, okay, well, if I think I could get to $50 million and I'm already doing 40, why don't I just do it? Well, timing is everything.
Yeah, I think the one question I would have for you to opine on as well on valuation is it comes back to like, how badly do you need this capability? How highly do you think of the brand of the agency, the talent, the customers, those things? A big informant to valuation is ultimately the retention and growth rate of the business. If it's consistently growing 10, 15, even 20%, which is pretty big year over year, you very much merit the top end of the multiples. If you're flat to kind of growing, that is going to impact the multiple regardless of how well you fill all the other boxes. Is that a fair statement or do you see it differently?
Very fair. And I honestly even get a little weary when someone's saying, well, we're growing 20% though year over year, because I'm typically only seeing that, unless you're growing through acquisitions, I'm only seeing that for newer, not new, but like newer agencies that have come into the market in the last few years, because it's not as sustainable, right? When you're getting to a business at scale, it's not as sustainable. And so I want to know why. And then also if it's a trend in the industry, okay, well, is that trend sticking? Is that going to go away? Right. And so for an established business, right, if they're at a slower growth, you're right, they might not yield the higher multiples. But if they've had consistent growth year over year, they do. That's when it goes up.
Got it. And then I think the second thing about this deal that's worth having a little bit of a chat about, because at the size of this deal, cash is a big thing, and there's a lot of debate about cash. The market for cash, what would you say the real range is for cash in these deals? 80 feels like it's the top, probably. Like, what is the range?
Yeah, 80 is definitely a top. I don't think I've seen one go above 80% in this space alone. We've definitely seen it in plenty of other industries, but in this specifically, I haven't really seen it above 80%.
What I've heard is that a HoldCo typically acquires for 60% cash and a 40% earnout or a roll of some kind, roughly, right? So if you're a strategic buyer and you're trying to be different from a HoldCo, you're going to want to at least acquire at 70% cash. So is it 70 to 80% is probably the way to really stand out from other potential buyers, outside of the fact you may not want to be acquired by a HoldCo, or you may have, a particular someone you want to be a part of. Like, what's your read on that?
Yeah, that is along with what I've heard. However, I was having a conversation with a seller that's going to market soon, and they had a conversation with a holdco. And I've just not done a ton of as much of the holdco deals, particularly in this case. And I thought they would say, okay, we don't want to sell to them, but they actually loved it. And they've been loving the conversation so far, and it's still early, so I can't tell you what it's actually going to be at the end of the day. But yes, if you want to stand out, I would say in the margins that you suggested. But the truth is, the seller is going to decide on the right deal based off of like their emotions on the inside. Yes, cash, but typically because team and clients are so important to this type of deal, they really need to have a good fit at the end of the day, and everyone needs to feel good about that versus just saying, well, it's the technology, I'm just going to hand it over and I don't really care at the end of the day.
All right. Well, I think that's a good wrap on scenario C. It's a pretty comprehensive look at all the key considerations. And I think, we'll go zoom out and say, look, all acquisitions have nuances of different things that inform ultimately where it lands. But I think the goal of these two episodes is really to help our audience think about what do deals look like in the 10 to 40 million EV range. And we did this really to take a little bit of the opaqueness out of what is really actually happening in market, and what are creative ways to solve problems when the deal is really big or when the deal is really small or there's unique circumstances happening. So we talked about three very specifically, although we illustrated four. So for the audience, whether you're a potential acquirer or whether you're a potential seller, I hope this was really informative. And Ayelet, I really appreciate you coming on and taking all of the experience you have from looking at hundreds of deals and simplifying them into these illustrative examples for our friends.
Happy to. And I think the last thing I'll just say is, I don't want to keep saying it over and over again, but when you're thinking about this as either an acquirer or a seller, at the end of the day, it's still buyer goals here and seller goals and needs here, and you find it in the middle. And like the creativity allows you to figure out what meets those needs.
Highly collaborative. We'll leave it right there. Thanks so much for joining Ayelet and I on this episode today. If you enjoyed the conversation, please like, subscribe, follow, share, do all those cool things. It's been great with having you with us. And until next time, we'll see you on the next episode of the Inorganic Podcast.